Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Microsoft stock again. I covered this one back in July, but I had a recent request after their most recent earnings report to take a look at it again. And so I'm going to do that. If you have a request you'd like me to take a look at, put it down in the comment section. I'll get the ticker on the whiteboard behind me. I'm almost finished with that one column. Microsoft's the last one there. So I'm working my way through these at a pretty regular pace now. As I said, if it's a stock that's in the S&P 500, I post those on YouTube for free. All of the rest I post on Patreon at the $5 per month tier level. So if you request something that's not in the S&P 500, I'll still make a video, but it'll be posted over there. Those links will be down in the description. I also have a $25 a month tier level on Patreon where I pick a stock each week and share. I just started that service in October, and it's going really well so far. And it's pretty fun for me to, even if I don't have my favorite stocks at exactly the prices that I want them, whatever's the best one that I can find, that is the one for the week. And I invest in all those ideas myself as well. If you join any of the paid tiers on Patreon, you also get a big discount if you ever decide to join the full Cyclical Investors Club over on Seeking Alpha. And I will have all those links down in the description, along with a 25% off affiliate link for Fast Graphs, which you see me use in most of my videos. So Fast Graphs comes in really handy for earnings analysis, just like the one I'm going to use for Microsoft, and also just looking at the historical earnings to get an idea what this company's been doing the past 20 years. As always, this is not individual investing advice. This is just how I analyze stocks. Okay, let's get into Microsoft. I went and looked. I forgot the exact date, but it was like in July. It was almost near this peak, actually, when I put out my last Microsoft valuation video. And I saw the title was, "It might not be as expensive as you think." When I looked at it, it's because it was about the same as the rest of the S&P 500 in terms of valuation. It wasn't because it was cheap at the time, but some people thought because it had this huge run that it was crazy overvalued and it was expensive, but it wasn't as any more overvalued than the rest of the stocks in the S&P 500. So if you want to own, you could either own one of the best companies that there is at that valuation, or you can maybe be buying some of these other companies that aren't as good at the same valuation. So that was kind of the point that I would sort of trying to make with my title there. Things have changed a little bit. So let's start by shrinking the fast graph down to the last. Let's see, I started this period. I moved the period forward 1 year because I'm going to be looking forward into their year starts in like June or whatever. So we're going to get 10 years of data, 9.5 that we have, or 9.25, and then looking forward into 2025. I think on the last video, I was 1 year behind on both of these because we hadn't quite looked. We didn't have this most recent quarter yet, so we were still in last year. But I was still looking forward to 2025. So here's where we are. Last year, earnings per share were expected to be, or the last time that I looked at the stock in July, earnings per share for 2025 were expected to be $13.28 per share. Now they're lowered. So analysts have lowered their expectation for 2025, which is notable, I think. In conjunction with that, though, I didn't look at the exact date my video was published, but I'm pretty sure it was near this peak. Since that peak in July, the stock price is down about, like, we'll call it 9 or 10%. So the earnings expectations came down. The stock price also came down. That seems pretty rational to me. So we can go and look at what the valuation is now that the stock is down a little bit, but also earnings expectations have come down. All right, into the spreadsheet. Let's see, where should we start? So I'm using the same 14. I think this was the same. I didn't change it just now. If I changed it, it was earlier. 14.75% earnings growth is what I'm going to assume for Microsoft going forward. That's a pretty healthy sum for a company that's as big as Microsoft, but you can see analysts are right in line with me. I based that earnings growth on this previous 9.5 years, And then I take off a little bit for the shares they bought. They bought about 10% of the company back, so I adjust that a little bit for those. There is no recession adjustment in that earnings growth expectation. So if we have a recession, it will probably be worse than that. But analysts are kind of right on target where I'm at, almost 15% if you average all these together over the next couple years. I don't think I'm doing anything too unusual using 14.75% earnings growth. All right. So the new earnings growth expectation, 1306 is what I have here. Let me make sure there we go. So that comes from right here, 1306. So what I want to know is if I bought, and Microsoft has like a little bit of net cap, there's not really any debt adjustment. It's super tiny. So really you're just dealing with the plain old earnings per share number, which is nice. So we have, the way I like to think about this is I bought the company for $100 at today's price, which is like $4.27. How much in earnings would I earn on my $100? So for every $100, you'd earn about $3.09. That's the earnings yield, 3.09%. Earnings yield is the inverse of the PE ratio. So you put the earnings over the price, that creates a decimal, and if you turn that in percent, it's 3.09%. So for every $100, if you own the business, move my head down to make everybody happy here, you would be able to collect $3.09 in earnings for every $100. So I use that to calculate my valuation. I pull the first year's growth forward, so I assume you'll be able to take $3.54 that first year and then collect that money, and the $3.54 will grow at 14.5% each year. And I want to know how much money my $100 would earn me after 10 years. And the answer to that is $71.02. So you start with $100, you end with 171.02. Put that in a CAGR calculator. That's how I get this 10-year earnings CAGR. So my spreadsheet calculates that, and right now we're at 5.51% 10-year earnings CAGR. In the last video, it was 5.2%. So it was actually more expensive in July than it is now. And you say, well, Corey, the price is 9% lower. Of course it's cheaper now. But you have to remember that the earnings growth came down, the earnings expectations came down. I didn't change my earnings growth number, but the base from which it works went down from 1328 to 1306. So some of that, even though it's cheaper, is justified because you're earning less money. The money that you start from is lower. But the stock price is actually corrected a little bit more than that, even still. So even with that lower earnings, the price has come down to give you a little bit better discount on the stock. So what that works out to here in terms of my buy prices, I like to have an 8% CAGR. It gives a margin of safety, and you get better returns when something does hit. Now with a company like Microsoft, it can be kind of hard to get it that cheap. I almost got it that cheap in 2022, but didn't quite get there. So, if a person wanted to buy a little before 8%, I wouldn't hold it against them too much. But just so you know what these buy prices are based on, that's what this normal buy price is based on. At $262 per share, that's, given all the assumptions we have here, that's where Microsoft would become a buy. That's 38% lower than where it trades right now. In the last video, let's see if I wrote this down. I didn't write down the percentage exactly, but it was 266.50. So I would still aim to buy it at a little bit lower price than I would during the last one, just based on calculations. This other number here is a recession calculation. Now we didn't have a recession baked into this earnings growth rate. So this is one way I kind of have a little bit of insurance against that, especially if we're going into a recession, like we're halfway through and you're trying to figure out whether you should buy Microsoft or not, or what price to pay. This is an average of the 2009 and 2022 drawdowns. So I have a calculation that I do based on those, and I kind of blended those two together a little bit because Microsoft's business has changed a lot since 2009. So really this is it's a guesstimate, but it gives you an idea. When it's really far off, it can keep you from buying way too early with some stocks. This is going to be pretty close, honestly, to what the normal buy price is, because what will happen during a recession is just as we saw this lower from 266 down to 262, the buy price here. If earnings expectations keep going down, like now they're 1306, we saw that they fell, right? Well, what if we have a recession next year and they go down to 1180, what they were last year? Well, what that's going to do to this buy price is it's going to get lower and lower the worse that earnings expectations get. Well, sometimes in a recession, those can get too negative. So it's entirely possible if earnings expectations during recession got too negative that this 225 buy price would actually be higher than the normal buy price. So it looks like it's very deep now. It's like a 47% drawdown. I think that's pretty reasonable actually for a recession drawdown. But as the normal calculation gets more negative and negative, this recession one will pretty much stay the same. So it's based on peak prices. Now it did come down a little bit because the peak earnings, I used forward peak earnings and they came down. But at some point, if we finish out this year and this is close, or maybe it only comes down a little bit, it uses the previous year as the measurement. So there will become a point where this just freezes in time. It will assume that there's going to be a recovery, whereas the normal calculation will just keep getting more negative and negative the worse the current earnings get. So, and that's one of the reasons why stocks can get cheap. So in that sense, the recession buy price helps you not get too negative and just always be negative with them. Basically, you'd be doing whatever the market's doing a lot of the time. So yeah, if there's no recession and there's just kind of some kind of weakness or something, this 225 to 262 is the range that's probably this stock would get bought by me. We're at 427, so we're a long way away from there. But I mean, I suppose if we just look back, where was it at just 2 years ago? Let's see. Oh, what do you know? It's like right at my buy price. So 220, that was 224. It bottomed at 213, and my buy price over there was 225. So you can see that that's not, and this wasn't even a recession. So it's not crazy to think that during a recession, if maybe they earn nine something a share, well, when the market's expecting 13 or 14 or 15 and they earn 9, the stock could lose that half its value. No, don't even think that it can't. Let's look. It lost over 35% just in the 2022 decline, and it wasn't even a recession. That peak PE was 40. This peak PE up here is something. Let me see. About 40, right? So you can see that that's not like I don't think it's like a crazy buy price. But something will have to happen within the market in order to get the opportunity, obviously. So, and we don't know when that's going to happen. But that's why I track like 700 stocks. So if any of them do, then I'm ready to buy them. All right. If you found this video useful, hit the like and subscribe button. Definitely check out the links to Patreon. I have a free tier there that I post all these videos, same videos on YouTube on. And so you don't have to rely on the YouTube algorithm. And eventually, and I have posted some extra content there. Probably be doing more of that this winter. I kind of took a break from the extra stuff this summer because I was busy, like enjoying life and stuff. But since I live in the upper Midwest, I get fewer opportunities to go outside and do fun stuff in the winter, so I tend to work more. So maybe I'll put and read more too. So I might do some more book style stuff that I put, like book reviews and things like that. Again, thanks for watching. If you have a request, let me know, and I'll see everybody later.